The Fed has been hiking rates and they're planning to hike in the future, but you think that rates are going to stay low for a long time. Can you help me understand?
Sure, yeah, it depends on which rates. I mean, obviously the Fed is hiking short-term rates and they expect to raise them all the way up to and above 3.4% by 2020. So short rates are going up. But the rates that really matter for bond investors are the intermediate to long-term rates. And what's priced into the market is that those short rates are going to get very close to and eventually go above 3%. And, so in the interim, while they're raising rates, if the scenario plays out, longer term fixed income securities, even treasuries, may end up outperforming cash. But the fact of the matter is, this is not unusual. Usually by the time the Fed gets around to raising rates, people can see the economy is doing well, they're looking through the cycle, and the rise in long-term rates is often mostly, if not almost entirely, over. So I think that's what's going on here. And there's a lot of fluctuation quarter to quarter. Just last September, the 10-year Treasury was at 2%. We've sold off a lot since then. A lot of things have changed. But now people may be too optimistic on the economy or on the risks to interest rates on the high side. And so as we've seen over the last couple of weeks, when we went from 291 and now we're into the 270s on the 10-year, may become more range-bound. We're probably closer to the top end of the range than the bottom would be our guess.
And when you look at the reaction to the recent Fed rate hike, what did you learn from that?
Sure. Well, it's very interesting that since the meeting, basically long-term interest rates have gone straight down. And, ultimately what kills an economic expansion is not old age, but it's the Fed getting involved and raising interest rates too much and knocking some kind of a delicate situation over into recession. And obviously we're not at risk of that now, but there are other factors that are giving the market concerns. We've seen concerns in tech stocks. We've seen more macro concerns about the deficit pushing down the dollar and steepening the curve earlier this year. And more recently, we've seen a lot of concerns on trade. We have a new, approach in D.C., America First, and one where bargaining positions at the most extreme are put out first, and then things are modulated as we go along, and the markets are adjusting to that. But basically, we've seen rates come down since then, and I think this is part and parcel not only of the rate hike cycle, where typically the long-term rates go up first. I think it also is in keeping with the roll-off. And that may be a little bit counterintuitive, but by the time the Fed gets around to letting their portfolio roll off, this is very important for the bond market, the impact of their not buying and reinvesting may already be in the market. And we've seen this before in reverse, and this is with quantitative easing, of which we had 3 phases in the United States, and we also had a massive program in Europe to judge by. And the European one is easiest in some respects because there was just one. By the time they got around to announcing and telling everybody what they were going to do and exactly how much and all of that, the 10-year Bund was at about 5 basis points. And within a month or two later, it had sold off to all the way above 1%. Right now, it's at 50 basis points, and we're basically 3 years on. So it has spent most of the time since the announcement, beginning of the QE, higher than where it was at that time. So the reverse of that is now they're doing quantitative tightening out of Washington, D.C., with the Federal Reserve and the FOMC and the New York Fed executing their policy. But basically, we're at the point where now they're forcing the market to buy what they would normally have reinvested. And this is particularly important now because the deficit is expanding. So the government is going from having a reasonably small deficit that was entirely financed by the Fed to having a much larger deficit, and that is going to get financed by the market. So people might think they have a bigger deficit. That is going to push up interest rates. On the margin, it pushes up treasuries a little bit versus other interest rates in the market. But it has other effects. Those effects are pulling liquidity out of other sectors, out of corporate bonds, out of structured products, out of high yield, and we've seen some give back in those markets relative to treasuries. And then we've seen higher volatility.